Hey guys, good afternoon. Caeli Ridge here, Ridge Lending. So I'm going to start by saying I need to beg indulgence today. You can tell that my backdrop is probably a little bit different than you're used to. Took advantage of some time in the sun with some family. And while I probably could have gone back to the room and showered and gotten ready and done it there, I decided not to. So yeah, and that's okay with me. Hope it is with you guys too. Thanks for being here. I'm gonna just make sure, yes, I hit record. I'm a one-woman show today too. Carly is on her honeymoon, and so I am kind of handling all the tech stuff. So I'm gonna have to be letting or admitting people as they come in. So if I'm stalling, that's why. I'm gonna pull up my notes, and we're just gonna get started. I'm gonna make this a kind of a hard stop at 2, gang, just so that we have um, enough time. I'm going to go through my content pretty quickly, and then I'll leave a few minutes at the end for any Q&A about the today's subject matter or anything else that you guys have questions about related to financing, okay, or real estate, for that matter, investing. All right, so today is earmarked. Yep, there's another enter. Yeah, I'm not very good at the multitasking with technology. Today we're going to be talking about preparedness for year-end closings. This happens every year, and I always like to take a minute enough in advance to give everybody that kind of 101 in terms of what they need to know and plan for, et cetera. Because what happens is in our industry and mortgage-related industries, the last couple of months of the year, it kind of turns into skeleton crews. First and foremost, 98% of our industry is almost exclusively focused on owner-occupied um, uh, transactions where you're going to live. Very few really focus on the investor. So as a result of that, you've got the holidays in November and December. So we have short months to begin with. You've got people taking extended vacation and time off because nobody's buying homes. Owner occupied people typically are not going to be buying homes in the winter time. So now flip that coin and then think about investors. This is the busiest time of year for us, hands down. November, December are the busiest times of year for us because investors are always clamoring to get their year-end tax credits. Everybody wants to get in their last minute purchases and or refinances. They've got closing costs and things that they can deduct. So this becomes a very, very busy time of year for us. And it's counterintuitive because everybody else is on vacation, underwriters, escrow, appraisers, right? The rest of the industry is kind of taking it easy where we've got, some of our highest volume in the last 2 months of the year. So as a result, I just always want to make sure that everybody is prepared that if you have intentions or plans to close a transaction between now and starting right now is not too early, I promise you. Between now and December 31st, it's really important that you get started and get your ducks in a row, et cetera. So a couple of things that I wanted to touch on where that is concerned. Um, make sure here a couple just quick details. Make sure you've got your documents that you're going to need, the things that expire or renew consistently, your pay stubs and your bank statements, your driver's license if you know that's going to expire, things that you would normally be prepared to submit, just have them handy. And ideally, we love it if you can get that turn time to 24 hours or less when items have been requested. I know that that's not always possible, but that would be ideal and certainly will save you some unnecessary heartburn. Um, I would also tell you that you need a minimum of 30 days, and you've got to count the holidays in there too, right? So take those out of the equation. If you're submitting a contract on December 1st, closing by the 31st, it's going to be, I'm not saying it's impossible, but it's going to be rough because you've got those days in the middle there that we will lose as rescission days and funding days for the holidays. So you need to plan ahead there. The other thing is that you want to, if you're going to be traveling for the holidays and you're going to be using a POA, a power of attorney, or the notary, even for that matter, all of those things need to be approved and handled in advance. So if you know that that's going to be part of your scenario, make sure that you communicate that with us, and we will, get everything handled and approved and ready to rock well in advance of actually closing. That'll be important. And then just being overall available for signing disclosures, getting to disclosures that come up and e-signing those quickly. all of those things are going to contribute to closing on time, the time in which you had elected to close, and not delaying or going beyond the 31st. Because like I started the call, those tax incentives, if something has come up in the middle of the year and you've made more income or you desperately need those extra deductions for the year, for you individuals, real important that you want to make sure that you're heeding this advice, because I can't tell you how many times the year end push, people miss the mark because they weren't prepared, and they end up having to pay more in taxes. Nobody wants that, right? So any questions about that, you guys? I'll look in the chat in just a second. Go ahead and throw those in there and I'll answer those at the end. The other thing that I wanted to share with you all is let's plan for 2024, right? Now is a good time to start planting those seeds and preparing for what might be your goals in the coming year. The first thing, and you guys hear me stress this all the time, do not file that 2023 tax return until we have seen the draft version first. Now, the only group that this doesn't really apply to are going to be those individuals that are just straight W-2. They don't earn any kind of self-employed income, and those individuals that don't have rental property already. So for those people listening here today or listening after the fact, straight W-2, no Schedule E, or Schedule E, Schedule C. If you make bonus and commission, as long as it's consistent and it's not in a decline, you wouldn't need us to review those tax returns, okay? So for you guys, don't even worry about it. We don't need to see the tax return in that case. It's going to be what it's going to be. But for everybody else, if you have rental properties and you claim or receive any kind of self-employed income, it's going to be really important that we get a copy of that in advance of qualifying. And obviously, gang, this assumes that we are talking about a full doc loan, okay? Full doc loan as opposed to a debt service coverage ratio loan, where we're no longer interested in your DTI, your personal income divided by your monthly debts. That's no longer relevant in a debt service coverage ratio. So if that's what you're after, then again, it's not going to apply to you. But if you're trying to go full doc, Fannie Freddie loans, or a non-QM product that's also considered full doc, make sure that we're reviewing that tax return in advance of your ringing the bell. Maybe your plans are to buy an owner-occupied next year. Another real big reason that we want to see that first, especially if you've been purchasing properties in 2023, and for a variety of other reasons. So we need to be able to calculate those gains and losses from all the different schedules that you might have and give you the feedback. And some of the feedback that we're going to give you is going to include things like, you know what, John, I really want you to file an extension. I don't like the way that 2023 return looks. 2022 was great. We already know that works. Let's file an extension and just buy us some extra time. That might be some of our feedback. For you individuals that maybe purchase properties late in the year, that can be problematic on a Schedule E because you won't have a lot of income to claim, but you're going to have a significant amount of expenses. So those two hand in hand are going to ultimately hurt you. So if your DTI is right on the line there, that loss, probably almost a certain loss, if the property was purchased late in the year, isn't going to be or work to your advantage. Or let's say you had a major renovation that had to happen, okay? We're going to make sure that your CPA commented and put the appropriate amount of days that the property was in service, because a lot of times their software will just default. If you've ever looked at your Schedule E, there's a place kind of in the middle, top middle-ish, under each of the columns for the properties that will say how many days the property was in service. And more often than not, the software just defaults to 365 days. Well, if it was out of service for 8 months and you only collected 4 months worth of income, but they left it at 365, the calculation is going to divide the income by 12 months, not 4 months, and it's going to bleed into probably producing a gain. So those are the types of things that we're going to be looking for on your behalf and providing you with advice that says, if you want to do this, then these are the options that we recommend. Obviously, you guys will make an informed decision based on that information. And, whether it means paying more in taxes or the deduction, et cetera, will be up to you to make that decision. And if you think it's helpful, we have a lot of clients, very sophisticated clients, that just don't spend any time understanding tax returns. And God, who would really want to? But if you just don't want to deal with it, it's very common for us to work directly with your CPA. Because as I've said before many times, the CPA's job is to save you money, right? Their role is to reduce the amount of taxes that you're going to have to pay if you've got a good one. They don't know underwriting guidelines. They're not going to know some of the details and nuances that go into a pre-calculated formula that Fannie Freddie puts out. So we're the bridge there that we can communicate with them. We can look at it together. We'll provide them the missing information that they wouldn't otherwise have, knowing what your goals are, and then we submit back to you. Here are the scenarios. Here are the options, and then you guys tell your team how you want to proceed. So real important. Let us see those draft tax returns. Now, similar to being prepared, this happens quite a bit. And I'll start by saying, guys, we get hundreds of tax returns that our clients want us to review, hundreds of them every year, throughout the year, depending on, whether they filed an extension or whatever. So please do not expect to send us a draft tax return a week before the 15th of April and expect to file on the 15th. That's not going to happen. I've got people that oftentimes will send it on the 14th of April and say, hey, I got to file tomorrow. Can you look at this? No, we can't. It's just it's not possible. So plan ahead. The sooner, the better, especially if you guys want one-on-one consultation with me personally. Make sure that you get those in. I mean, if you can press your CPA, if you're one that files on time every year, if you can get that return in January or February, amazing. We'll have plenty of time to look at it and go back through and strategize, etc. So that's a big one when we're talking about what to plan for 2024 and what you want to do. Let me look at my notes here and see. I know that there were some other things that I wanted to share with you in that regard. I talked about that. The other thing too is communicating with us, your dedicated loan specialist, or if it's me that you're working with one-on-one. Just understanding what it is that you want to accomplish in the year. And it's not just about real estate, right? Maybe you've got to buy a new car. Your lease is coming up, or your tires are falling off, and you need to have a new vehicle. Or maybe you've got a kid that's going to be going off in college, and you need to co-sign for a student loan. Whatever those variables may be, having the discussion with me or your dedicated loan specialist is going to be important so that we have those details. And when we're working the calculations of debt to income ratio, we can include those things, right? And position you so that you're able to accomplish all of the things that you're trying to do for the year. And planning ahead is important, right? If you ring the bell, it's wrong, and there's not going to be much that you can do after the fact if we didn't know and prepare for it. Okay. So credit, that's the other thing that we want to look at. What's coming up? What has happened? When do we want to feasibly pull credit in the year, knowing what your kind of transaction dates are going to be? Let's say that you just did, you're in the middle of a fix and flip, maybe, okay, just as a random example, and you've leveraged your utilization in some of your credit cards is really high, and we've got something that's coming up in, let's say that we're in February, we have something coming up as a purchase, a new construction. Let's say it's a Florida new construction that was delayed and it's finally going to close in June, right? So having those conversations and understanding what your plan is will allow us to prepare you appropriately and say, okay, listen, the credit report is good for 120 days. That's how long for most programs from the day that we pull your report to the need for a new report is 4 months, 140 days. So knowing when to pull the report to maximize your credit score to make sure that A, the qualification is there, right? There may be some minimum credit score requirement, or B, we're yielding the best rates that we can. There are differences between interest rates if you had a 720 versus a 760. So those are some of the other things that we would talk about in scheduling some time with your dedicated loan specialist. Similarly, assets, right? Does everybody know how to calculate the reserve requirement? Is everyone familiar with that? Do you know how to read, if you're using retirement accounts, do you know how to read the terms of withdrawal of those accounts? And is it eligible for satisfying a reserve requirement? So those are some of the conversations that you definitely want to be having in advance, again, so that we can prepare for hitting all those milestones and making sure that you're getting everything done in the year that you want to get done. Let me just take a pause, and I'm going to talk about kind of state of the market. Let's see if there's any questions though from you guys. And for those that joined a little bit late, you'll notice I started the call by saying my backdrop is a little bit different than normal. I was begging deference and just hoping that you don't mind. I took advantage of some sun with family here in Scottsdale, and it is glorious. I almost feel like I should show you my view. Maybe I'll do it before we leave. Okay, I don't see any questions. Nobody going once? We've got one from Sean. Hey, Sean. His question is it 25% down with DSCR, debt service coverage ratio loan? Can you go over the 140 days per background check again? Nice, Arizona. How'd you know it was in Arizona? Did I tell you that? So yeah, you can do 20% down on a debt service coverage ratio. I'm noticing, and this is the same for conventional too, gang, the difference between the points for the rate at 20 and 25% down. A lot of times, I think it's to your advantage just to put the extra 5% down, because what's happening in that case, this is actually a really good question, Scott. Excuse me, Sean, I'm glad you asked it. This gets into secondary and being in a high rate environment right now, everybody. If you've heard me talk on this before, and if you haven't, this will be probably real good intel for you. The servicers that pick up the rights, the mortgage-backed securities that are bought and sold on the secondary market, the servicers pay a premium for the rights to service these loans. And by service, it means who that you send your payment to, and they disperse the funds, and they're there to answer questions about escrow and all that stuff. That's your servicer, who you make your mortgage payment to. They send the taxes to the county, the insurance to the insurance, the principal and interest, yada, yada, right? Well, they pay a premium for the right to service these loans. Now, what's happening is in this high rate environment, rates aren't static, right? They're not a straight line. They go up, they come down. And I think that everybody is in agreement. They will be coming down at some point. When? I'm not going to get into that today, probably. Well, we'll talk about rates in a second. But 6 months, 12 months, 18 months, whatever, it doesn't really matter, but they are going to be coming down. When the loan pays off, the servicer is going to lose money, because the premium that the servicer paid to get access to service that mortgage-backed security usually takes about 36 months from acquisition before they're profitable. Okay, so if that loan that you locked at 7.5% refinances in 24 months from then, it's going to be at a loss to the servicer. So they understand this and they're hedging. So any of you that have seen or have gotten a loan done or seen a quote in really the last year plus, you've noticed that there's extra points associated with it. That's why they are covering. There's no premium pricing. You don't get to choose to pay 0 points right now. You're paying those extra points. So anyway, questions about that, let me know. But back to your question, Sean, debt service coverage ratio has both 25% down and 20% down. But I would encourage you to get quotes on both. It can change daily based on the market and see, right? How many times have you heard me say, do the math? It'll be easy to figure out which option is going to be better for you. That 5% difference in capital versus the payment difference, divide the two numbers, right? It'll give you the number of months it takes you to recapture. I like to say, and largely depending on how long you're going to keep the property, 2 years or less, you probably want to put more money down. If it's more than that, given that a lot of times I think that we are going to be refinancing in the next couple of years, put 20% down, right? Anyway, and if you guys have any questions about that math, please just email me and call me and say, hey, here are the two scenarios. We'll look at the rates. We'll do the math together. The more times you do it, the better you're going to be at it. Just let me know. And then, Sean, you said, can you go over the 140 days per background check again? I think you're talking about the credit report. The credit report, this is a conventional guideline. We do have some products that are 90 days versus 120 days. So make sure you inquire about that depending on what kind of financing you're getting. But more often than not, it's 120 days or 4 months that the credit report itself is valid for. So we pull it today, and 120 days later is when we have to pull a new one. So the reason that's important is depending on what you've got going on, if your credit card debt is being utilized above 50%, right? Your credit cards, or you're doing a rehab or something on a property or whatever, right? It doesn't matter what's on there, but over 50% utilization, if you have a $10,000 limit and you've got a balance of 5,000 or more, that's when your scores really start taking a hit. So if you know that that's the case, we just need to plan it. right? There's a couple of quick hacks I'll give you guys since we're talking about this. If you don't want to throw a bunch of money at revolving consumer debt at that point in time, you've got it earmarked for something else. One kind of loophole, you can always go back to the creditor and ask them to extend the limit, increase the limit. So you might have to wait 2 to 4 weeks before the system updates. But in that vein, obviously you can't charge anything more on the card. But if you've extended or increased the credit limit and you've left the balance alone, you may not have to throw any cash at that. You can just kind of trick the system, if you will, to see a lower utilization, right? And lower utilization, better credit score, etc. Let me know if there's anything else on there, Sean. I will address it. We've got another one from Doug. Hi, Doug. His question is, how long after having high utilization, but it gets paid down, does the score react? Good question. I'll read the second part in a second. Well, no, that's related, isn't it? For example, if I just charged an expensive family, maybe trip, and charged up my Discover card, but we'll pay it off in 2 weeks, how quickly will that be reflected? Excellent question. And it's going to depend on the day in which the creditor reports to the repositories. Okay. So, and everybody's going to be different. So what you're going to want to do is you're going to want to call Discover and you're going to want to find out, hey, Discover, what day or days in the month do you report the data tape, their data tape, to the repositories? Repositories are Equifax, TransUnion, and Experian. Okay. So when you find that out, what day of the month, then you can kind of figure out on which day you've paid it down, when it's going to be reported. You want to make sure that you're not pulling or allowing us to pull or anybody to pull until you've hit that mark. Okay. Perfect. Yeah. If you pay off every month, great. But just find out what day of the month or days. Sometimes they report multiple days in the month, what days those are. And then we can plan accordingly to make sure that when we run your credit as needed, we'll do it once it's reflective of hitting the repositories and optimizing that score. Good questions, guys. Thank you so much. All right. So I'll look back here in a second. Let's go to interest rates and my prediction. Let's talk about the Fed. Okay. The Fed has been extremely clear, I believe, I guess in the Fed language. I mean, if you're not used to it, maybe it doesn't sound as clear as it is, but they've been pretty straightforward about what their intentions are with interest rates. And not from what I've seen, I have not seen them do anything but make good on the expectations that they've set. They have continued to stay steady. They are dead set on the inflationary rate being 2%. My own 1.3 cents worth, you guys, I don't know where that number came from or why that is the absolute end of all ends. I can't answer that question. It's actually a good question. I wish I could. But that's what they're after, and that's where I think they're going to ensure that we are before they take their foot off the gas. Now, that said, a lot of people, grumblings, I'm hearing, rates are going to stay high for longer than I think a lot of people wishful thinking out there are predicting. The Fed, I think that if you guys want to know what's going to be happening with rates, start listening to the Fed. It's all published. They have their minutes. They they meet, I don't know, what is it, 12 times and 8 times a year? I don't know. But you can get all of that information and start reading through that and listening to what they have to say, and you should be pretty clear on what happens. Now, take all of that and put it to the side for a second, because there are circumstances, of course, that can derail everything that I just said. And the hard truth of it is that the better the economy is doing, the higher the rates are going to be. Okay, that's just the way it goes. The worse the economy is doing, the lower the rates are going to be. We can't have it both ways. Do we want gas and food and these other things to be more affordable? Or is that what it is that we want to see happen? Then we're going to see the higher interest rates. It's as horrific as it sounds. Great tragedy tends to couple with lower interest rates. Example, those horrible images that we're seeing over in Israel. I won't get into a political conversation here, but that could be a catalyst that drives interest rates lower. So there's exceptions to the rule, and just know that the better the economy is doing, you're going to expect that the rates are going to be higher. That employment, the jobs The jobs report, I can't figure it out. And people a lot smarter than me have been wrong in predicting that, but that thing is just on fire. I just, and I don't understand it myself, but that's not helping interest rates. I'll tell you that. Anyway, um, uh-oh, somebody is in and wants to come in a little bit late. Let's let him in. There's Jag. Okay, so my prediction for interest rates, I think they're going to be higher for longer. But I'll tell you something else, gang. I'm seeing cash flow, man. And remember, we're licensed in 48 states, and we get all the appraisals. We see it all the time. I get to see what the cash flows are, and I'm still seeing it at 7.5% and 8%. We've got debt service ratio at sometimes 9. I've even seen higher than 9 when your credit score might be a little depressed or the loan amount's really, really low. Both of those criteria tend to make debt service ratio rates higher than normal. But cash flow's out there. And if you're saying that you can't find it or you're not able to cash flow, then you're looking in the wrong place. You need to start opening up and finding other markets to consider and or start considering the short-term rental market or the mid-term rental market. One thing that's interesting, and I'll leave you with this unless you guys have more questions. Um, you know, diversification is key. My overreaching advice to every one of you is diversification in some way, shape, or form. Have your core strategy, but you need to be diversified. And that statement comes from my own mistakes, my own past, my own background. I was a one-trick pony. It was all about appreciation. It was just kind of a one particular strategy, and I did not have good diversification, and it was a problem, a big problem. 0809 kicked my ass. Okay, I won't get into that sub story. But one of the things that's really cool that I have been talking about lately is a midterm rental. Now, everybody knows the traveling nurses, furniture finder or furnished finder, I think it is, pilots, people that are on the move all the time. Those are fantastic. But check this out. What about the idea of professional athletes? Now, you're going to want to be in a state where it has all the major pro sports teams. Ohio might be a good one. That's the one that I've just been using because that's where I first learned about this. Football, basketball, baseball, hockey, right? Those are the four main ones. So you want to pick a state that has all of those. And on the higher end, you're probably looking at, depending on the market, of course, at least a $400,000 or $500,000 property. But think about these kids, these pro athletes that have signed a contract of 2 or 3 years. Typically speaking, they're not from that area. They're traveling from home to be present for that season of that sport. And what is being required is that they're made to sign leases for several years at a time. And the other thing too is a professional sports athlete. These kids just to be on the roster are making. I mean, they're 20 nothing, right? They're making what, $500,000, $750,000 or more. I mean, that's their base pay, so they can pay the rent necessary. And like I said, they're being required to sign this lease for 2-3 years at a time. So I just think that that's a really cool way that mitigates even more risk. The returns seem to be really good from what I've observed so far. But that just might be another feather in the cap, things to look at and consider when you're diversifying. Jag says, okay, what do you think of areas like Cleveland where the population is declining year on year? Uh, I don't know if I'm qualified to answer that. I guess my instinct would be it you would expect then that the housing prices will start to follow suit, right? If that's really happening in that area, I would consider neighborhoods. Don't just I wouldn't blanket it to just Cleveland. I would be looking in lots of different areas of Cleveland. But there may be some advantage that you can lever there. Um, and if the population is declining, appreciation might be declining. Find out, the city will typically find some tax credit or some way in which to incentivize businesses to be there. Start looking for those things. And if there's going to be big box business, then you're going to want to find out where they're building and where they're hiring and where their pool of employees are coming from. They're going to need housing, etc. So, yeah. She says also, it seems the steady cash flow markets are often the ones with slow and steady declines in population. Maybe. Yeah. I mean, there's exceptions to every rule. I feel like a broken record sometimes because I say the same things a lot. But generally speaking, gang, the higher the appreciating market, and this I'm talking about long-term rental, single-family long-term rental right now. The higher the appreciation, typically the lower the cash flow, and vice versa, right? The lower the appreciation, the higher the cash flow. Diversification, I think, is the key overall in every way, real estate and investing. So single family, short term, midterm, 2 to 4 units, class A, B, maybe even some C, appreciation markets. Look for that exclusively as long as it cash flows something and offset with some real strong cash flow. And look at some alternative means as well of investing. Syndications or private lending notes, right? All of those things are part of real estate, and I would be looking at diversifying at least in some way with one or a multitude of those. Okay, so I think that's it, unless I don't see any other questions. So I'm going to call it. It's 2 o'clock. Thank you guys for being here. I really appreciate it. You know how to reach us, but I'll just tell you. ridgelendinggroup.com, info@ridgelendinggroup.com, 855-747-4343, 855-74 Ridge. We are on standby. Anything you need, just give us a buzz. I'll see you guys in a couple weeks. Thanks for being here today.